Our next guest says that rally, this recent one, may not last, as he is on the lookout for slowing economic signs in the weeks to come. Joining us with all of his predictions is Chris Grisanti, the chief market strategist and senior portfolio manager at MAI. All right, Chris, it's great to see you. What are some ideas? What comes to mind in this crazy market?
So you got to celebrate the second quarter comeback, even if you're a skeptic like me. I mean, the market soared 25% off of its lows. The question is, where does that put us? So we're back to 24 times forward earnings on the S&P. That's more than one standard deviation above the 30-year average. And that's okay if earnings continue to grow, but estimates for this year are 11% and next year 12%. Those are pretty aggressive. You add the tariff headwinds in, and I think it's a good time to be cautious rather than to reach for more performance.
What does that look like for you?
So for me, it looks like not going to cash, but this has been a tale of two markets. Healthcare, for example, has been the whipping boy of this market. It's got terrific cash flows, investment grade balance sheet, and the lowest valuations it's had in a decade. And in fact, healthcare is now the lowest percentage of the S&P that it's been in at least 25 years. So that's a value section. It certainly has some near-term headwinds, but I think that gives us the opportunity to make investments at decent prices and plant some seeds.
Also, Chris, I mean, one of the other value sectors that's getting a lot more attention these days is the financials more broadly, not even just the big banks, but also some of the insurance companies as well. The financial sector has, over the last couple of years, been that sector that people have pointed to as being the one that could lead this kind of broadening out type rebound. Do you see some of this momentum continuing for the banks, especially given what we're seeing on the regulatory framework?
I do, Dom. I think that's a great question. You've got financials, you've got industrials, you've got economically sensitive sectors that are doing just great right now. So you'd say, well, that would push back against my be cautious. But I really do think, so you had a kind of crummy first quarter, you had a terrific second quarter. I like to say the third quarter is going to be the tiebreaker. And I think the tie gets broken in favor of a more difficult economy. I think that will prevent the financials from continuing to lead the way. So I would skate to where the puck is going to be. And I think that's, more cautious, more economically immune stocks, like healthcare.
Any thoughts on the big, beautiful bill, Chris? Whether either it's short-term or very long-term
I think it passes, Kelly. I think there's a lot of drama. I think there's too much momentum behind it now. And I think they're going to be wrapping the things up. And again, I think this is, a short-term positive for the markets. It will add to the momentum we've seen. But I do think that this rally since April has been a gift. And so let's not look the gift horse in the mouth, and then let's reposition for what might be a more difficult second half of the year.
Chris, is this a market, and I say this in light of, in context, Fed Chair Jerome Powell's comments out of Sintra today in Portugal, where he said, in essence, we would have cut interest rates by now had it not been for tariff policies being put into place. Is this a market that needs the Fed to ease in order for it to continue higher?
Yeah, I mean, we get asked that a lot from our clients and others. And I think be careful what you wish for, because I think the Fed only eases when it sees signs of economic deterioration. And once we're there, the market doesn't necessarily do all that well once the Fed starts easing, not because they don't like low interest rates. We love it. But because they're easing, because the economy is slowing, because unemployment is rising. So I unfortunately think the Fed will hold on until that starts to happen. So I wouldn't look to Jerome Powell or lower rates to save the market.